Hey everyone, Sam here. Let's get started. So today is another session of supply demand zones at work. All of this information comes from the original supply demand strategy that I developed in the mid-90s on the trading floor of the Chicago Mercantile Exchange. Let's get started with today's topic. First, remember, the Pinnacle Institute is not an investment advisor. I am a licensed fund manager, and there certainly is no guarantee of success when it comes to trading and investing in the markets. In fact, available research shows that the majority of active traders lose money. So be careful, take your time, don't rush. And most of all, make sure you understand risk and are okay with risk. A lot of people move too fast in this. You don't want to do that. Take your time, understand it, and then measure performance and go from there. Today's topic is whoops, there we go. Everyone can hear okay? Okay. Let's keep going. Sorry about that. Wasn't sure we were connected there, but it looks like we are. Okay. So, profit zone. We're going to talk profit zone a little bit, and we're going to look at some opportunities from the past few days and today to see how we apply our profit zone rules. Profit zone in its simplest form is the distance between supply and demand, retail prices and wholesale prices, specifically the proximal demand line and proximal supply line, right? In the middle, we know we have fair value, but to keep things very simple, it's the difference between our proximal demand number and proximal supply number. That's what we base entry, protective stop, and profit target off of. You can see in this example, out of our live trading sessions, we had identified a supply zone up here. That's this one. The arrow should be pointing up here. Anyway, and then the demand zone all the way down here. Remember, the distance between supply and demand, which is that and that, is our ultimate profit zone, which in this case was about a little over 600 NASDAQ points. Okay. And then we just let supply and demand do its thing, right? The key is to apply structure and location analysis to identify all that, and it's just following rules. Now, if we look recently, remember recently we've looked at this one before. We had our supply zones here in the Dow, and then over the past week and a half, we hit those supply zones and turned lower. Yesterday and today, we reached the opposing demand zone down here, the 325 demand zone. We closed into it and then late last week on Friday, I believe, and then this week have rallied out of that, and prices are moving higher, right? But this is the Dow ETF. This is the Dow futures. Ultimately, it was these supply zones here. And then over the past week and a half, prices just came down to, again, the Dow demand zone down here, and now prices moving back to the middle. Okay. Remember, the distance between these two, and even though we're looking at the Dow futures here versus the Dow ETF today, doesn't matter. It's still the same Dow, right? We can measure profit zone across those that market because it's the same market. It's the distance between supply and demand. We also always want to identify fair value in the middle, which we have here. And then we apply our profit zone rules. Make sense? And then we let the governing dynamics of supply and demand do what they do. Competition to sell at supply up here causes price to turn and pushes it lower. Right? Prices reach retail prices, they turn and fall down to wholesale prices where they closed on Friday last week, and then yesterday turned higher, and today are continuing a little bit higher. Right? Competition to buy at demand causes price to turn and pushes it higher. That's how the governing dynamics of supply and demand work. In its simplest form, that is the definition and application and result of profit zone. Hopefully that was helpful. See you tomorrow.